Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. It's only a couple months away, so be sure to act real quick there to get the best deal. All right, back to the show. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. And this week, we're just back to the duo, Quinn and I here, chopping it up. It has been one of the heavier weeks of economic data releases that I can remember. So there's going to be no shortage of things to talk about. So, based on that, I have a feeling that it's going to be a pretty chart-heavy episode this week. So, yeah, if you're listening on audio, recommend switching to video because there's a lot of interesting charts, a lot of interesting data points to get into. But yeah, going to be a good one. Quinn, what's going on? How's your week?
Yeah, man, solid. May. It's F1 down here in Miami this weekend, so everyone's got stuff going on. It's sort of like the final cap of Miami season. It kicks off with like spring break and Miami Music Week and stuff, and then it ends here before everyone leaves. When it gets humid,
it just gets too hot and humid and everybody leaves.
Yeah, gets sticky, man. I mean, honestly, it's really not that much different than like New York City in the summer. I mean, it is worse, but temperature wise, it's actually about the same. The temperature doesn't change. It's like you wake up and you're sweating and you go to sleep and it's the same. So It's kind of nice though. Your skin is like immaculate.
Yeah, I like that. I've where I moved is you get a lot more sun than where I was at before, and I can already tell the difference. I'm like, man, us Canadians, man, we're missing our vitamin D. You can tell the difference.
Yeah, how can you not smile when you wake up to beautiful days?
Exactly. Cool. Well, yeah, we pushed this so that we could record after the NFP jobs report, which came out this morning. So yeah, man, let's get right into this. It was a strong report. Jobs came in at 177. Significantly above most expectations, which is super great. Unemployment rate, well, great if you're an econ bull. Unemployment rate stayed somewhat flat. I think the unrounded went from 4.15 to 4.19. So, 4 basis points change. Nothing crazy there. Average hourly earnings month over month came in slightly below the expectations of 0.3, which is interesting. But yeah, super strong report. What was really interesting is looking at there was some pretty significant revisions for the past few months, and I don't know. It's funny to think about like a year ago when revisions were what everybody was talking about all the time, and there's just so much talk about it just being a political thing. And I think this really just sends home the message that this is just how statistics work. It's just what happens when you. Yeah, it's a survey, and then as payroll data comes in, they're able to revise it to be more accurate, and people will try to spin up narratives, but overall it's just this is how the game works. And there's just huge revisions because seasonal adjustments and like every economic data point got whipsawed all over the place after COVID, and it just was one of them. And so now we're back to the normal times. And so yeah, I don't know, I feel like nobody talks about this anymore, which is kind of
but whose revisions are those Trump's revisions or Biden's revisions?
Yeah, exactly.
Whose jobs are those?
Yeah, if they're positive revisions, it's Trump's, but if they're negative, they're Biden's. Don't you know? Yeah. What I found really interesting though was looking into the unemployment by cause, and we actually saw a pretty significant uptick in the permanent layoffs component of unemployment. It if we are heading towards a recession, which we can debate about a bit more, but this is it's a black line for a reason. It's danger. The most dangerous of all these lines here is if that starts to surge significantly, that's really hinting at a pretty significant layoff cycle. But what's also interesting is that the new entrant component actually downticked, which this is the one that's most related to the immigration that we see. That was a pretty big hallmark of the Biden administration, just running huge immigration numbers. And we're starting to see a downtick in there. So that's pretty interesting. I'm sure we can get into that some more as well. Once again, whenever these jobs reports come out, I just lean on Econ Berger. He's like the best labor market economist, in my opinion. And he always has really great charts that come out just in time for these roundups. But this one he noted was really interesting because it shows the average work week for transportation and warehousing. And so you can see in the data here, just this mad dash to get tariff imports in. So you're seeing increased work weeks for these employees, which is really interesting that we're starting to see some of these weird whipsaw effects start to show up in some of these, NFP isn't a full on hard data point, but I wouldn't call it soft either, somewhere in the middle, but it's interesting to see that start to show up. So yeah, lots to get into. Interesting to show how the Fed funds futures market is reacting to this jobs release. And overall, we've seen bond yields surge higher. This was quite a bit stronger than what most expected. Obviously, it's not going to have the full impact of anything post-Liberation Day or anything like that. That'll be the next month. But yeah, pretty strong report. How are you thinking about this, Quinn?
Anna Wong from Bloomberg, got to give a hat tip to her. She called this to like an absolute T from the get-go and has been very consistent with the view that the downward effects on the labor market just from a time perspective aren't hitting yet. And so it's not going to show up in the data just because people are scared about trade wars. That doesn't mean that jobs prints are going to be negative. So it was fine. I for that same reason, like also don't take much from it, right? Like it's if things just haven't progressed on a calendar yet, it's hard to read into it too much, in my opinion. I think that the native foreign-born thing is interesting. I was tweeting about that this week, and pretty objective. There's a very strong correlation if you plot these numbers against the border encounters, which obviously effectively dropped to zero overnight when Trump took over. There's a high correlation between the foreign-born new jobs and immigration. I mean, I guess I don't have anything that says causation. Like I don't. To me, it seems obvious. I don't know. Maybe there's some people that said that doesn't equate to causation, but that was one where, I mean, it's noisy data, but this month there was a huge reversal in terms of, foreign-born, like you said, ticked down or native ticked up. So, that's, I guess, good for domestic people. It's probably not good barometer going forward if that continues, because it's just less workers, probably fewer, lower growth if you have a smaller population. But yeah, maybe there's a couple slides I pulled down from the report Anna Wong at Bloomberg was mentioning, was just how this is kind of a no signal in this report, and it's really the next 2 months that are going to start showing weakness. This next slide I have shows the by month what the seasonal factors of sector job growth. So you can see in May and June, they're huge leisure and hospitality. They're big trade and transportation, and they're big construction, right? So this is like summer, everything in the summer, Midwest, and where it gets cold, everybody starts working on the roads and buildings, trade and transportation, and leisure and hospitality. So you can go to the next one and see where she also lays out a number of these things. If you look at the New York hospitality sector as just maybe a leading indicator, we've already heard, there's been fewer, inbound foreign flights to the U.S. This is an example. 2025 in the red line has not really kept up with the previous 3 years at all. The next slide has transportation and logistics, which show quite a pretty big fall off relative to previous years. And so really the crux of her message was like, they predicted 165 and that it's sort of a nothing burger because all the real meat on the bone comes next month. So yeah, I mean, when you look at the Fed expectations, clearly the bond market's re-rating higher to a more hawkish lean, and it'll be interesting to hear how they talk about it next week. I don't think there should be any surprises though. I mean, the economy's holding up, and the tariff uncertainty remains. So it seems like they're just going to repeat the same message we've heard for the last like 3 times Powell spoke.
Yeah, I think it's pretty baked in that obviously there was pretty much no expectations of a cut in May, but I think what's more important is just the guidance for the June meeting, which I think last I checked, odds of a cut in June are at like 60% or something like that. And I think if we saw a pretty weak report today, we could have seen an increased odds of some sort of guidance towards solidifying that June cut. And yeah, I think that's pretty much off the table. If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. I think there's a big theme at hand of a lot of this data that, obviously NFP is a pretty lagging one, but I'll just pull up, like we got the ISM prints this week and we also got GDP, which we'll get into in a second. And overall, I feel like it's really starting to set up what I've been starting to think about as this mirage of positive economic data, just due to these weird whipsaw effects in terms of how people are trying to navigate these tariffs. So we got the manufacturing PMI. We had, one of the big themes for me has just been the dispersion between new orders and prices paid. And we've started to see, a pretty significant downshift in new orders, which actually did bounce up a little bit this past month. But regardless, at the same time, prices paid, which, if you just intuitively think about the sequence of how these components work together, is that, the new orders is the most leading, and then, comes later on is the prices paid. So we're seeing that initial surge in prices paid after the huge surge in new orders. And then it's really interesting when you take that and compare it to what we saw in, obviously, what's always so important in macro is just understanding like what data point is leading versus coincident versus lagging, because we're looking at survey data here, which is somewhat leading. Here we have quarter over quarter of Q1 for GDP, which is not leading at all. And we saw a negative print there. But what was really interesting is really digging into the weeds. It's really important, especially during these times where net exports is just so volatile, to really look into the key driving factors of GDP. Aside from that, I think there is, I jokingly tweeted out that it feels like we're going to be starting to talk about like super core GDP in the next couple months and that idea, but there is some validity to it, because if you look at investment, it absolutely surged this past month. And I think, there's some more work I want to do there, but overall it feels like, we've seen the huge surge in imports. We've seen, businesses try to front run, CapEx and investment decisions up front. Consumption did downtick somewhat this past quarter, but it's still positive by all accounts. It's really just the story of net exports making for a very noisy print. And we've already seen, you can see just in that gray chart there, the most recent point is actually just incorporating the Atlanta Fed GDP now print in there, which is already back to positive, because a lot of that, tariff front running into net exports has already been put in place. And then now the core components get in there. And if those core components are still, if you think intuitively that we have all these imports, then you have, the investment associated with that. That's going to lead to an uptick. At the same time, you have consumers that are starting to see, real world impacts of these tariffs in terms of, when they go to order their, crappily made Sheen stuff from China, you have a 100% tariff on there. That, will change consumption habits quite significantly, especially when you compare that to, where consumers' savings rates are at in terms of how long they can hold up to it. So I think the constellation of all of this, I think, is going to create a mirage where the economic data is going to be a lot stronger for longer than most expect, and that it's going to be a mirage. So I think if you're thinking about what is the negative growth impulse that comes at the other side of this? You need to extend your time horizon, I think is the big theme that I'm starting to get here. What do you think?
Yeah, and it's the exact reason we were saying we'd get a big relief bounce once all the hysteria left, which is it's going to take a while to show up. And so classic, right? I feel like we've earned the right to become more cautious up at these levels, given we were bearish going in. We were talking about buying that dip, and now we've had the big relief bounce. I think soon Trump will just have GDP X Biden, and it'll be like 10% every quarter, just like all the negative categories. I also think there's a lot of similarities between this and COVID, but when it comes to supply chains and uncertainty and maybe a near-term demand shock, but in one, you had the government locking everybody in their homes, and the other, you have everyone's going on with their lives and just maybe trimming around the edges. So there's a lot of differences there. I thought it was funny too this week. There's a headline or article on Bloomberg that because a big problem if the U.S. is no longer taking all of these cheap goods from China is China needs to dump them somewhere, and the obvious candidate is other developed markets, i.e., Europe. And so they're starting to debate and in some cases put on their tariffs of their own. And in France, they've put on they call fees on small parcels. It's like it reminded me of that meme where it's like the American mind couldn't comprehend, and then like in the comments there's all these like European versus American things. It's like, well, those beers took 2 hours to get, and then Europeans saying something about Americans, and it reminded me it's like the American mind wouldn't comprehend, and it's like this tariff rollout plan where it's like the French are like, oh, just a small fee on the parcels. It's all, it's for the benefit of the people. And then Americans like, fuck you. Like, here's 150% tariff. And then they both land at 10 or 20. And it's like, just the tale of two worlds. Yeah. But yeah, I mean, you can't change your 12-month economic outlook on a whim. And for me, it's still negative. I don't think, despite all the hopium talks about deals with everybody, we're still going to be in a tariff world, and we're still going to be in a Trump admin policy moving forward world across the board. So I think there's a lot of stormy seas to still be navigated this year.
Yeah, 100%. It's been interesting. We're starting to get some data of that actual tariff revenue start to show up. And this has been a great chart just looking at year-over-year comps of tariff revenue. And it's so hard to actually get a clean look into what's actually happening in terms of tariff revenue collections because it feels like they change every day. But, you can obviously see in this blue line that it is increasing significantly. I think it's something like a $30 billion increase versus year over year last year. So, yeah, I mean, regardless, I think a lot of people in the world still need to come to terms with the idea that the effective tariff rate is not going to go back down to where it was. Just before recording, I saw a headline that the U.S. is telling Japan, who a lot of people are expecting Japan to be one of the first trade deals, and that it's going to go super smooth. And even there, they're saying there's no chance that we're cutting out the 10% reciprocal tariff to Japan, and that's just a non-starter. And if that's the discussions being had with what feels like one of the easiest lift countries to get one of these deals done, I think it's pretty clear that at a bare minimum, those 10% baseline tariffs, I don't think are going anywhere really. So I feel like, people need to come to terms with that still.
And Japan just said, hey, by the way, we're the biggest holder of your government debt.
Dude, yeah.
We might not use it, but it's a card. And it's like, they're just stating what everybody already knows. I mean, it's Besant knows that better than anyone. The thing that I address to people and, my investors, they're all family offices, high net worths, like well-to-do, people with money. And a lot of them don't, and just people I speak with in the investment community don't relate necessarily to why Trump is doing what he's doing. And I've tweeted out a number of times different like viewpoints of just objectively, like I think people in evaluating this whole scenario are just, there's a lot of emotion. There's a lot of maybe disagreement with what's going on, but very few takes and analysis points to why it's happening. And so that's what I think it all boils down to. For example, when we were bearish on the Trump policy agenda, everyone couldn't believe it because he's the stock market president, et cetera. But it's the why. He was elected because of to rebalance towards labor away from capital. He feels emboldened by the lower middle income class to make things more fair, and all these policies. It's not that they want stocks lower; it's a byproduct of lower growth and higher inflation and reshoring, et cetera. And the same goes in the other direction, which is he rolled out the tariff policy. Many people who like what he's doing say it was all part of the plan, and now he shifted the Overton window, and we're in this world where 10% is the minimum, and before, if you said 10% tariffs, people would have lost their shit. There's some truth to that. And then you have the other side that's like, oh, he's going to roll back completely, and there's going to be trade deals. But what that misses, and I think it's funny because in all these talks, you're seeing like China push back and kind of just have their arms folded. Japan's being stickier than people would like. Europe example as well. There's no deals yet, and everybody seems to be posturing less favorably. Yet the market continues to price in more and more hopes of trade deals happening. And there's this maybe it's complacency is the word. Maybe complacency is too strong, but this feeling that of people that I speak with that is like, oh, well, he's going to backpedal and reverse course. We're going to do trade deals, but that misses the whole point. It's like the whole reason to roll this out is to reshore, to bring jobs back, to lift up the middle class. Yes, unfortunately, it's very difficult to do that and rebalance the economy and send stocks higher. Like you'd love to do that, but it's hard. And redistributing wealth usually is never done in a way that makes everybody more wealthy. It has to come at the expense of someone else. So I think there could be some mistakes made later this year if you don't just truly understand why this is happening, and that this is not we botched a strategy, it was too boisterous of a rollout, we're going to walk back. It's like, no, we're plowing forward. We're managing the markets so we don't create a financial crisis on top of all of these other things. But their policy agenda is not changing. It is absolutely hardened as ever.
I think it's somewhere in the middle where it's like, yeah, we fucked up a couple times in our execution, but the state of play remains the same. And I think a good reality check was actually right before we started recording here. Trump released his basically wish list of a fiscal bill, which I have here, which is really interesting. I think this is a pretty important reality check to see that, yes, where they're focused on still remains the same. So if you just look at, base discretionary funding, they want to cut by 10%. So non-defense spending, they want to cut by 22%. That is still very much the Trump 2.0 playbook. They're not walking away from that. To the other side of that, they want to increase defense spending quite significantly, like 13.4%, which is obviously huge. But it's still obviously the goal is that they want to be able to offset this with something else. It's not an outright increase. It's a different story whether this actually gets passed. This is just a wish list. But overall, when you look at on aggregate, that creates a net decrease of 7.6%. That is still where their head is at. We can debate the story of whether this is realistic or not. But in terms of just the folding on everything that has been the state of play of policy, it's clear that they're not fully relenting yet. It's just about meeting somewhere in the middle, and that middle is still quite significantly different from where we were in December.
Yeah, I think there's similarities here between people getting sucked into headlines and not really, and some people don't follow this stuff that closely, so they just follow headlines and no problems. But people are glued to tariffs as the only stock market negative thing going on in this administration. Like, economy and stock market are also two different things. And everyone's now found relief in tariffs not being as bad, which we actually don't even know. When in reality, there's all these other things that are super growth negative going on. And in the same way, everyone has been glued to Doge. And again, like when you lay this out, it sort of does paint the picture itself that this could be a decent strategy. If you're the Trump administration, who's, they know they're going to get a lot of flack in the media no matter what happens, this rollout kind of makes sense. I don't know if that's even true or not, and I don't pretend I have the answer, but everybody's glued to Doge. Elon this, Elon that, Doge this, Doge that. They're going to make the cuts. They're not going to make, it's this big thing. But what everybody's missing is that all of the talks behind the scenes in the traditional, normal, regular course budget reconciliation and financing plans are going to make the bigger impacts. Like Doge is a cut here, a cut there. New president, executive orders can come in, create new agencies, yada, yada, yada. They're not as lasting anyways. It's about efficiency. They literally say it's about efficiency. It's not about removal. The real thing to be nervous about is the actual normal course budget cuts, which is what you just laid out. And so everybody's
saying the Senate
saying,
wants to go big on it. That's the
exactly.
issue,
And they they have they have to move on this. It's their opportunity, and they have both House and Senate. You're exactly right. And it's like there's so many of these things where it's like the market and hysteria and headlines latch on to, tariffs. And then there's like no immigration and reducing fiscal spending, negative growth more than tariffs are. And in this case, it's like, oh, well, they're not going to do Doge. Well, the big thing is like they're distracting you with Doge. Meanwhile, they're doing like huge slashes in the normal course budget. So like people need to just like think on their feet a little bit.
Yeah, but the issue here, I think, is that that's what the core like executive branch and like Trump want to do. And I think there's holdups in terms of like the Senate bill that they're proposing is like a huge increase in fiscal deficits. And like this is the issue of trying to figure out like where do they want to get versus what's happening. And so you look at like where, deficits as a percentage of GDP are, we're still in the same crazy fiscal dominance world that we're in of a 7% GDP deficit during a time that isn't recessionary, so you have to square out what do they want, which is what we just showed, which is like a 22% cut to non-defense spending. But in the same vein, you also have the prioritizations of, some of these instilled, Senate members in Congress that want to keep doing what they always do, which is just keep on spending money, increase deficits, keep running a 7% of GDP fiscal deficit during like a non-recessionary, like that's a recessionary play, is to have a 7% of GDP deficit. So you have to figure out where does that all net out between like what they want, what these other parts want, and where does that actually lay? So it's hard,
I guess my point is just all I see nonstop, which is telling me it's way too consensus and almost like lazy. It's the most lazily regurgitated thing, is like nothing stops this train and it's just one way, which I believe in the end of the day, I do believe there's a government induced put on financial markets. And the question is, where is that put when it comes to either Fed or fiscal spending to stimulate and, reignite or prop up markets and the economy? But like all of this stuff is predicated on like, they can't do anything in April of the new administration. Like there's physically nothing that they could have done like to change what's already been enacted. We're rolling in February, March, all these monthly numbers. That is a predetermined budget, pre-Trump, all these things, pre this Congress and Senate. I mean, obviously a lot of overlap in members, but so you can't, I'm just like saying, like, to be intellectually honest, you can't say, well, Trump and Doge isn't work, their priorities aren't working. It's like, well, this isn't their budget yet. Let's see. I totally agree. I'm skeptic. I don't believe anything politicians say. So let's see. But it's not fair to evaluate the Trump admin's budget cuts on the last 3 months until they get this through, is my point. Yeah, and obviously there's the tax cut thing too. There's the tax cut thing too, which I'm still scratching my head. It's like, want to cut, discretionary, increase defense, cut tax. Like, I don't know either necessarily how much they get done. So I'm not saying like they're going to do it. It's just like, it's not really, doesn't make sense to talk about these historical deficits because they don't align to anything that this admin has done.
Yeah. I think the takeaway is it's super fair to not, you can't fully judge this when they haven't even put their bill on the table yet. These things take time, especially to get through Congress takes time as well. So, if it's not even on the table for discussion yet, you can't fully judge it yet. I think that's a pretty fair assumption, and people are getting ahead of themselves. But I mean, on the other end, when you have Elon saying we're going to cut $2 trillion, that's not doing him any favors either.
Yeah, I mean, even going back to that Lutnick interview where he said, Elon and him were going to announce, 500 billion each. Elon on budget cuts, Lutnick on growth, and then Elon goes to the press conference and says 2 trillion, and Lutnick's like, "What the hell? That's not what we." So it's like there's a difference between campaign messaging and what actually happens. Look, I don't know what's going to get done, but I do appreciate Elon's ability to round up a couple tech savants and entrepreneurs who literally are billionaires to work for 100K in the government. Like, I'll take that. That seems like a good trade for the taxpayer. But yeah, let's see. I mean, again, this is all part of the reason why we bounced so hard and the data is still fine, because this spending is still existing through the next budget. This fiscal year that was already set for the government spending is continuing in the background. And so it's not that crazy that job market's not falling apart and consumers still somewhat have money to spend.
This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the number one institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure nodes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ondo.finance, and see how they're bringing capital markets on-chain. Restrictions apply. All right, I want to talk a little bit about another point we got this week was the QRA release from Treasury, which, it's always so funny. Like it felt like the biggest, point, like data point for so many months. And I saw Andy Constant, who, to be fair, has been on top of this for a lot longer than most of us in terms of the QRA stuff. And he's like, man, it doesn't even show up on my Bloomberg now in terms of it being like a relevant data point. But you and I, we were still digging through the data points, through the documents this week. We're still holding the strong to it. There's some interesting things in it. Overall, they held coupon issuance constant and guided towards keeping that for a while, which wasn't really surprising for me. The main thing that I was interested in, which came from Scott Beston's interview a few weeks ago, where he hinted at, we have tools on the table if we need to manage Treasury liquidity. This is back when, I'm old enough to remember when the 30-year was trying to break through 5% and everybody was freaking out, and they're asking Besson, what would you do in that situation? And he mentioned one of them is obviously around Treasury buybacks. And so we had some guidance come out in terms of the Treasury buybacks, which has been ongoing for a while. And there's a lot of nuance that's required. So I'm just going to read out what was mentioned in the QRA here, which is that given the success of the buyback program since its launch last year, Treasury believes it's an appropriate time to consider ways to improve its efficacy. Accordingly, Treasury will evaluate a broad range of possible enhancements, such as changes to maximum purchase amounts, buyback operation scheduling, frequency, security eligibility, maturity bucket composition, execution process, and counterparty eligibility. So overall, there's a lot of different ways that the Treasury can execute on Treasury buybacks. They do it through two different realms. They focus on the cash management side of things and then improving liquidity. When we talk about improving liquidity, what they do is that I've talked about it a few times on the show, but basically on the long end of the curve, you have on the run bonds and off the run bonds. Off the run bonds are just any, QSIP that is not the most recent of issuance, and they're super liquid. The big buyers of those are basis trade hedge funds and that sort of thing. And effectively, like what happened in 2020, the reason the Treasury market seized up is because those off-the-run bonds that just are super liquid basically went no bid, and the whole thing seized up. So what the Treasury does now is that they will keep the duration matched in terms of, okay, if they're going to buy a bunch of 20-year off-the-run bonds, they're also going to basically issue the same amount to keep it duration matched. There's a lot of different ways you can do that. So that's been what's been going on. They've been doing, every month or two, like a $2 billion operation on the long end there. And so what they're talking about now is trying to both scale up the scale of the dollar value of those off the runs that they buy. And then what's interesting to me is when I see things like the maturity bucket composition, that starts to head into the realm of basically like a Treasury buyback 2.0, I want to call it, where if they were to do something like issue bills and then take those proceeds and buy the long end, you're starting to talk about something that sounds a lot like kind of what the Fed does in terms of an operation twist. But obviously the absolute dollar value doesn't change because they're issuing and then buying back. Whereas when the Fed does it with QE, it's just an outright purchase for central bank reserves. So yeah, it was really interesting. What did you think about all that?
There wasn't really anything. It was a nothing burger generally, I think. The Treasury buybacks is interesting, I guess, but it's pretty around the edges. I mean, there's no people are all the QE people. Is that QE?
They're getting way too fired up about it. Yeah, way too fired up. I just got to say that.
It's like they're just basically rearranging the chips on the table. They're not adding new chips. Exactly. Which, yeah, around the edges is good. But I think, the interesting thing to me is yields on the year aren't really down. So I guess 10-year, but looking more at the 30-year, I think it's like flat, which, that's a number of things going on. But yeah, they ultimately, the direction of travel is more coupons from the Treasury, and the Fed needs to shorten the duration of their holdings. So, oil's down. That's good for, bond yields to be lower. The trade war hysteria is abated. Yeah, I think the outlook for bonds, especially long duration bonds, is really challenged. I'd say still need to be proven that these cuts are going to come through to the budget. Those are very helpful to the strength of the U.S. balance sheet, but I think the market's probably in a we'll believe it when we see it.
I think, yeah, the hysteria that Treasury buybacks are going to lower bond yields and that sort of thing, I think is super misplaced. I think really what it does is it cuts into left tail risk a little bit, similar to what I talked about that happened in March 2020. It just lessens the odds of that market basically going no bid. But I don't think it really does much to change the absolute fair value yield of these bonds. So I think overall you're right that it doesn't change much for the picture of how cooked long bonds are, honestly. I think we're both in that camp right now.
The other I would say is that in the bear column that's not good is in evaluating the aftermath of the week in April where bond yields sprinted higher while asset prices went down, which is the opposite of what normally happens. There was every attributing factor possible kitchen sink thrown at the Y, right? The market moves, it's price, narrative, price. And so bond yields raised higher, bonds sold off with risk, and everyone's like, this is not how things are supposed to go in a healthy economy. Why is it? Oh, well, it's foreigners selling and it's the basis trade blowing out. And then you get the data of both. We're sitting here a month later, and actually foreigners were buying, and the basis trade open interest of futures, Treasury futures is not down.
Yeah, and so it's just the swap spread, boys, but that wasn't even that big either.
Yeah, and that's not great. That's not a great fact pattern. If you're sitting here, looking at the rubble and you're saying, wow, foreigners liquidated their holdings and the basis trade blew up. You're like, okay, well, at least that's gone, right? At least there's a clearing event. This would neither actually happened. And yeah, I would just say buyer beware on long duration US debt, but any debt globally.
Yeah, and I think what's important there is that everybody keeps looking for some sort of big breaking point to catalyze the QE bros to come in and say, "Oh my God, QE's coming. They need to backstop the Treasury market." But I think what we're saying too is that there's not really any major issues. Like if you just pull up, I have a chart here of just reserves right now. We've been chopping around flat, and roughly speaking, the way the Fed thinks about reserves in terms of like an ample regime is somewhere around 300 billion. So yeah, we're getting to the lower end, but they're already tapering QT quite significantly. And then in the same vein, this has become my favorite chart for understanding monetary plumbing stress. It's the New York Fed's reserve demand elasticity. And it just really shows that, yes, we've had little sputtering moments at the end of quarters during window dressing moments where we see these all these various acronyms start to blow out a little bit, but this is by far the best way to gauge that stress. So if you look at the last time this blew out was September 2019 during the repo spike, where the Fed had to come in overnight, and look at this chart. Look what was going on there. There was multiple months, like 6 to 8 months of reserve demand elasticity falling apart, and then it finally capitulated in September 2019. That's when the Fed came in and started operating and opened up the standing repo facility, which is permanent now. It's already there. So you have that. You have reserve demand elasticity that's just chopping around flat. There's no stress. There's nothing. To your point, the basis trade is okay. There was some hiccups and swap spreads and stuff. Foreigners were not selling to the degree that most people were dooming about, and the monetary plumbing world is chugging along fine. So there's nobody coming, and there's no need for them to either, really.
Yeah, that's not relieving if you're long bonds, because
exactly. Yeah.
They see saying someone knows something that caused them to do that, and it wasn't. Yeah, there was no flight to safety. Let's put it that way.
Yeah, it honestly it starts to become more of just almost like a political decision. I've been thinking about it, of whether they want long bonds above 5%. And that starts to get into the world of, it gets closer towards something like yield curve control, and whether they just politically do not want to have bond yields above 5%. And you need the Fed to cooperate with that idea, and I see no signal there really either. So to me, it just feels like this steady drift upwards in bond yields, especially if this recession, if it comes, is going to take a lot longer than most people think.
Yeah, it's just, very cautionary on long bonds. The thing I think is just funny, if you zoom out here, the fact that we're talking about these like liquidity facilities and maybe the guys can put up the chart of the 30-year yield minus the 2-year yield and look at the historical curve. We are in a still very depressed steepness level of the yield curve relative to history. And it just shows the anchoring bias in the market. Everyone's like, oh my God, yields are so high. No, actually, this is an extreme anomaly we're coming out of. So everyone's anchored to this like very not how the world normally functions world where there's no cost of money, to a world where there is. And in a normal environment, we should see another over 100 basis points of 30-year over 2-year steepening. So, that's, it's just like, it's good to zoom out and recognize where we're at in long-term historical like trends, and if that mean reversion is due, because the fact that we're even talking about it shows where sentiment is. And like there's no rule whatsoever that yields can't go above 5%. There will never be a rule, and there shouldn't be a rule. It's markets are functioning normally, and there's a cost to capital. And, it's just the fact that it's not good for risk necessarily, but that's the only place this comes from. Like no one is, oh, the bond yields can't go above 5. It's like, why? Well, it makes my stocks go down. It's like the same thing with tariffs. You can't tariff and protect our national security. Why? Because my Apple stock is down. So who cares? Like, it's just kind of like, so anyways, I mean, the thing people aren't talking about in this, I think, is the housing market, which how does the housing market recover in a big way, which is such a predominant driver of the economy when yields can't go down. And it's such a big driver of the economy, construction jobs, building. And so that's a pocket of the market I'm watching for continued weakness, or maybe we get a bounce, but I'm skeptical.
I want to take what we've been talking about and contrast it with market structure right now and where the markets are at, because it feels like a lot of what we're talking about is that these therapeutic catalyst moments that drive the capitulatory washouts is going to take longer than I think a lot of people expect. And at the same time, you have what I feel like is a lot of people that are pretty rightly bearish, but I think are going to be tested and have been tested on that. And I got this interesting chart just looking at ES futures liquidity right now, and it's horrendous. It hasn't recovered at all. And so to that point, that allows for much higher variance and for smaller size to move markets. And so you see these huge moves. So you have this consternation of what I feel like is going to be this mirage of good data that is going to confuse people for too long and really test their conviction on the bear thesis. At the same time that you have these market structure dynamics where this is a classic bear market, where you just get these huge rallies that just squeeze everybody out on super low liquidity. And so I'm starting to see we're getting to the levels where, say, on NASDAQ QQQs, we're back to the level pre-liberation day now, and people are like, what the fuck, like how is that even possible at this point? And it feels to me like the trend is going to continue for this just really testing of this thesis while we get these weird whipsaws. So yeah, like how are you thinking about trying to navigate the market structure versus like the economic fundamentals, which we've been talking about?
It's the toughest part of the job, I think, in macro, especially. You can have such a strong view and it takes always way longer to play out. Let me read. I just sent investors our May update. I think some interesting tidbits in there, but the email we sent to investors on 4/7, we said this recent sell-off has been too much too quickly relative to the forward outlook for risk in the economy. Tariffs and trade wars have taken the bulk of the headlines. This too shall pass, and the more important policy adjustments still lie ahead. The recent initiatives have actually achieved their goal of reducing inflation and allowing the Fed to cut. Lower bond yields have helped bolster the market a bit, and the sharp decline in oil and commodity prices are actually a tailwind to consumers and markets. Next on the agenda is more pro-growth items. I expect investors to acknowledge the shift in policy focus and find relief from the current tariff tantrum. While I don't believe it's all roses through year end, I believe it's prudent to play for a bounce to 5,600 area on S&P and 100,000 area on Bitcoin. We may even still see a recession this year, but some of the swiftest and most violent rallies occur during broader bear markets. There remain headwinds to navigate over the course of the year, but markets don't go down a straight line. For the first time in months, we are tactically bullish on a multi-week to multi-month time horizon. Yeah, it's just classic bear markets. Like the liquidity is down and everyone's off sides, but nothing fundamentally under the hood has changed. And now, in fact, it looks even worse because everyone's lowered their earnings expectations for corporates and prices are back and so multiples are higher. Yeah. And Trump wants to spend less and the Fed's not cutting and there's liquidity issues on the horizon and there's no immigration. So yeah, just don't lose sight of that. Don't get whipsawed, hold your views. When we retest at 4,800, maybe it's a good buy again. But, when we retest up here in 58 or 59, if we get there, it's a good sell. And it's just going to be just a bunch of chop and you got to be active. Like, you got to be looking at things through the risk reward lens and you're not going to catch the tops and bottoms perfect, but you got to be looking at these areas.
Yeah, it's so key to just stay preserved too on your capital too. Like there's personally myself, I've been taking risk off from my active book and just trying to just sit in some cash and just not try to overtrade. Had a lot of good wins over the last month or so and want to secure those. And to your point, where the market is at now in terms of multiples is even worse arguably than when we were in February or something like that. So you have to respect that so much and just either lower your sizing, lower your overall allocation to risk, increase your cash holdings. You can still play these tactical swings. It's a lot of fun with this high volatility. You can get some big swings, long or short. But overall, you should be looking to protect yourself. And if you had some good wins, take some chips off the table and just enjoy them. Summer's about to start,
Yeah, I mean that low liquidity swings both ways, right? Because if you get some real bad news, there's no trade deal or new The agenda is not changing. Remember a couple of weeks ago, they said there's going to be industry and sector reviews, month by month for pharmaceuticals and semiconductors and chips and agriculture. And those are still coming. Like Lutnick is still there. Trump is still there. Today's a Trump day in the markets, but there's going to be a lot of Biden days ahead too. So, yeah, my outlook hasn't changed that I don't think the S&P 500 will return positively this year. So we're almost back to flat or something, getting close, I guess. So, now's a good time if you if you didn't take any chips off early in the year. I don't know. Might last a couple more weeks. Who knows? We probably have to rinse out more bears, squeeze everybody, get everyone really off sides, and
But we're in a classic squeeze,
Yeah.
I think, and I don't see any reason for it to stop anytime in the next week or so. So yeah,
Careful.
People are going to get
That's
tested.
usually what people say at the top.
True.
I can't imagine any other reason.
I've been taking chips off anyway, so I don't.
It's impossible to call tops. You don't know what the next tweet's going to be. You don't know what the next thing next nickname for Powell he's going to have or whatever. It's like you just have to play the risk reward. You can never predict it. You have to just play the best odds for every given price. And we're getting price movements that are like weeks compressed into days.
Exactly. Yeah.
And that just is a reason you have to be more active, because normally the S&P is at like a 12 or 14 vol and it's like sleepy for weeks, crazy week, sleepy for weeks. Now it's like madness, and you just have to be more active or sit it out and say, hey, let's wait till there's certainty and clarity, or just buy huge dips. But chasing up here is not the winning answer. Pick any of the other options.
100%. And you don't have to be, I harp on this a lot, but you don't have to be max bull or max bear. It always still confuses me so much why people have to think, they ask us all the time, oh, Quinn's bearish. Oh, Felix is bullish. Oh, Felix is bearish. Quinn's bullish, or whatever. And that's just not how you should be thinking about your portfolio. You should have some longs in case you're wrong. If you're bearish, you should do the opposite. It's a spectrum. Like risk exposure is a spectrum, not a light switch. And too many people forget that, and any given day I could have something where I'm bearish on, and then I'm something else that I'm bullish on. So, to ask me whether I'm bullish or bearish just makes no sense. And then it's about, bullish or bearish for what asset class, it's like,
yeah, exactly. And the other thing is you need to evaluate markets, and every price at any given time is a point on a probability distribution. So we might be all the way we might be, 60% to the right side. And, so it's not as optimistic as if we're in the gutter, but there's still some upside. So maybe I'm going to be 60% allocated. I'm cautious. I'm not all in chips in bull, but it's like people, these binary movements, like as if the whole probability distribution only can shift to one side. No, he's bearish. Boom. You can't have partial positions or ease. It's just hilarious. Yeah.
You will not survive markets if that's how you operate. Just,
your brain,
market buy max long.
Even if you got every call right in that situation, your mental would be fried and your anxiety would be through the roof, because that's just not how you should be thinking about things. You wouldn't 100%. Sleep. So, but it's if you bought the dip at 48 and you can get out here and we receive 48 again this year, you're looking pretty good. I mean, that's a whole year's worth of P&L. So just don't get greedy. Yeah. It's not no top calls. Just don't get greedy.
Speaking of top calls, I want to ask you about MicroStrategy. To wrap up here, they had their earnings yesterday, and you nailed, I think, to the hour, the top of November. And I think you're trying to do it again. So what's going on there?
Yeah, this one, it wasn't as clear. I mean, sort of poking some fun, but and again, that's another example where people are like, is he bearish? It's like, well, actually, if you're bearish, it doesn't mean they're different assets. You can be look at all the times in history where MicroStrategy has underperformed Bitcoin and Bitcoin's gone up. That's happened a lot. That happens very often. It's interesting. You mentioned a tweet on this. I've been talking about this for a while. The increasing share of retail flows in the market, particularly on the buy side. Frankly, that's another comparison to COVID. In my opinion, retail was came onto the scene in the markets and really moved things around. And you look at the assets that are moving, Palantir's back at highs, Spotify, Hood, all these retail stocks. Crypto falls in there probably, MSTR. So yeah, it's interesting because they've all outperformed. We had MicroStrategy's earnings this week, yesterday, announcing a re-up with ATM. It was pretty expected. And so, yeah, he's still got a lot of firepower, so it's hard to fade Bitcoin, but it's a coincident indicator, right? Because if the MicroStrategy premium falls off a cliff, then, there's no more firepower to bid Bitcoin. And he's clearly a big part of the market. So you have to figure out ways on your own to formulate that into a strategy. But yeah, it's getting to the point where like his prerogative here is to be issuing shares pretty damn hard. Like we're at a NAV premium level where like he should be flooring it into corn. So yeah, I don't like the outlook for the premium from here, is basically the message. But I didn't get my within the 30-minute top tick this time, unfortunately.
Always a good one. All right, I think we can leave it there. Keep catching up.
Yeah.
A lot of data to get through. Hopefully a little bit of a lighter week. Although we do have FOMC. Is that next week or the following week? I don't even know.
Next week. Next Wednesday.
Yeah. Okay, so yeah, no letting off the gas in that regard.
No, all gas, no brakes.
All gas.
F1 weekend.
Yeah. Oh man, have fun with that. I'm jealous. Are you going to it?
I probably not. Just stuff around it. There's lots going on. I don't really. Everyone that goes just parties there anyways. So it's classic like how Miami would turn anything into Miami, like just it's like DJs and party. It's like, oh, it's a horse racing event. It's a car racing. It's a poker game. Okay,
it's Miami.
How many DJs? Yeah. What DJs are playing? And like, so, it's people have fun.
Right. Cool, man. All right, well, have a good weekend.
Yeah, you too, man.